Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of Thor Financial Technologies and Portfolio Manager of THLV, the Thor Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker. Today we have Ragen Stienke. He is the founder of Ballast Asset Management. They have a long history in the space, specifically small and mid-cap SMA products, and have jumped into the ETF world a few years back with their small mid-cap active ETF, MGMT. I think you're going to find this conversation extremely interesting, specifically around their fundamental process, as well as how they view and evaluate management and how they view and evaluate risk. So without further ado, please enjoy this episode with Mr. Ragen Stienke. Hey, Ragen, welcome to the show.
Thanks for having me, Brad. Excited to be here.
So before we get started, can you tell everybody a little bit about your background and how you got into the position that you are today?
Sure. So I'll go back a little ways. I think it's will be helpful to offer some of how I got my start. So my first job out of college was with Arthur Andersen, and this is the mid-'90s, and I was in the business valuation group there. I like to say that's where I learned to value things in the real world as opposed to an academic perspective. It's also where I met one of my business partners, Jay Singhania. He and I have known each other for 30 years now and worked on and off together. Then went to UBS in New York. I was a software analyst initially, and then moved into the strategy role. And there I worked with my other business partner today, Tom Fogarty. So I've known him for over 20 years. Was recruited to a company called Westwood here in Dallas back in 2004. And it's where Jay and I started the SMID strategy there at Westwood, and raised $3.5 billion, raised another $1 billion or so in a sister strategy. And then I left in 2015 and started Ballast the day after I left. Historically, we have managed primarily institutional capital. Of that $4.5 billion, probably 85 or 90% was institutional. And then 3 years ago, through or I should say, as a result of an SEC opinion letter that allowed active managers such as ourselves to have the same efficiency and an ETF strategy as the passive guys, we launched the first, to my knowledge, small and mid-cap actively managed ETF. So that brings it through today.
Yeah, that's great. And before we jump into that, I always like to ask everybody, what interests or hobbies do you have outside the office when you're not, behind the computer screen running money?
Sure. Well, I'll tell you, I have 4 children that are all relatively young, and so one of my interests and hobbies is coaching them in youth sports. I've spent a lot of time doing that. But outside of that, I'm a big outdoorsman. I love hunting and fishing, and I love sharing that hobby with my children.
Yeah, no, that's great. I'm actually you're in Dallas, so are you still in Dallas?
I am in Dallas, yes.
Yeah, I might be adopting the Cowboys as my team this year because the Steelers are just awful. So,
well, I will tell you to be careful. The Cowboys are certainly good at breaking hearts on with a regular occurrence.
Yeah, they've had some high expectations and have not done what they probably should have been doing over the last couple of years. But they're my team this year, and I also coach youth sports, and it's very fulfilling and fun. And I got a couple of kids, so I definitely know where you're coming from and can relate. So let's talk about Ballast Asset Management. I know you have the ETF, which we're going to talk about. Are you guys did you start out running SMAs and then converting SMA assets into the ETF? Is that kind of how you got your start?
We did start out running SMAs and continue to run SMAs today. Um, the way I think about our ETF, it's the same strategy. It's just a different vehicle for accessing. Same strategy. We have a single strategy. This is all we do. We've done it for going on 20 years now, and so yeah.
So let's dive into MGMT, which is your small and mid cap ETF. Can you give kind of a high level overview of what the strategy is trying to accomplish and what it's designed to do?
Sure. What At the highest level, what we are trying to accomplish is to turn alpha generation into a manufacturing process rather than a process that is reliant on either my or any of my teammates' ability to be right all the time. And that really starts with a focus on quantifying downside. That is really the cornerstone within our process, and I'll take just a minute to explain, because there's I think an important distinction between buying something at a discount to its intrinsic value or with a margin of safety, sort of the common buzzwords that you often hear, and, and what we do. We're ultimately trying to buy within 20 to 30% of the worst case scenario that we can envision. And once we quantify that downside, then we'll look at the upside, and this is where we're forecasting a base business out 3 years, coming up with price targets. And then very simply, we're marrying those two bits of analysis such that we have this downside versus upside. We call that, we invert that and call it a reward to risk ratio. And we're looking for asymmetry of at least 3 to 1. And again, our process is reliant on exploiting that asymmetry and being extraordinarily consistent in applying this framework over and over and over again, as opposed to using things like conviction or some of the other common buzzwords that you hear thrown around. And the reason for that really is that when you use things like conviction or probability, you are inherently exposing yourself to many of the behavioral pitfalls that we as humans are subject to. I'm a huge student of behavioral finance. I won't say that Kahneman and Tversky are required reading to work at Ballast, but it's heavily encouraged. And so we're trying to do everything we can to take as much of, put as many guardrails in as we can to protect ourselves against those behavioral mistakes.
Yeah, no, it's definitely important. I'm a big believer in behavioral finance and trying to avoid those pitfalls. I mean, everything we do is systematic as well. But before we dive into kind of like the investment process, I want to get your take on why that small and mid cap space offers such unique opportunity, specifically for finding kind of alpha generating companies and higher growth. What is it about that space that you find attractive, and what is it about those companies or maybe the management team specifically that allows you to drive and generate that alpha?
Sure. There's a couple of things. One that I don't often hear talked about, but it's actually become worse, I guess, better for active managers over the last 20 years. And I'll take you back to the 90s when these stocks traded on fractions, 16th and 8th, quarter of a point. We moved into the early aughts and we went to decimalization. And initially, those commissions were 5 to 7 cents. They're down. Commissions are down to a penny or half a penny a share in a lot of instances these days. And the reality is that many of the large brokerage firms that use commissions from their trading desks to pay sell-side analysts to cover these stocks just don't cover these because they don't trade enough to generate enough dollars to pay their analysts. So we've seen over the last 20 years a remarkable drop in coverage for many of the businesses that we own. And while that makes it a little more difficult to get up to speed, it rewards folks that are willing to roll up their sleeves and to do the work themselves.
So let's talk about kind of the investment selection. I know you talked about, the risk and reward ratio. I mean, are you looking at that through like a fundamental screening process? Like, how are you drilling down and finding opportunities?
Sure. So it really starts with eliminating things that uh, we just know we're not interested in. We have valuation framework that we're not willing to pay more than, let's call it, 12 or 13 times EBITDA for a business. We want our businesses to have operational leverage and not generate returns through financial leverage. So we're extraordinarily focused on balance sheets. Um, we don't mix, again, uh, cyclicals with financial leverage. Um, we are exceedingly focused on management teams that are very capable of deploying capital at very high attractive rates of return and who get paid based on their success or lack thereof in doing that. So that's really kind of step one for us. Super focused on free cash flow. Having worked again at Arthur Andersen early in my career, I can tell you that companies are able to manufacture earnings through accounting gimmickry. You can distort book value. The one thing you can't distort is cash going into and out of a bank account. So those are really sort of the primary metrics that we are focused on early on, as we get interested in working on an email.
So you briefly touched on, looking at management. What specific qualities are you trying to identify that makes a great management team that you're comfortable with and taking an investment in their company?
Right. And I'll just for your listeners, I'll tell you, we actually wrote a white paper on this. It's on our website if you want to get deeper. But we've got kind of a management checklist, and it goes into a couple of things. First and foremost, we want to make sure that management is aligned with our customers, and we do that by really digging into how they get paid. And notice I said how, not how much. We want to make sure that the metrics that are used to determine what they get paid are, aligned with when they win, our customers. So just as a quick example, if you are a retailer, a CEO of a retail company, and you get paid based on revenue growth, the easiest way to grow revenue as a retailer is to just build more stores. Well, that may or may not be the right answer for our investors. That incremental capital being deployed could be done at at dramatically lower rates of return. And so the focus should be just focus on your existing. That's a big component of it. The other thing is evaluating throughout the management's careers how well they have done at deploying capital, either previous jobs or previous divisions within the same company. And then the third piece is making sure that the management team that is there is the right fit for that company at that time, right? So having a manager that is exceedingly focused on growth for a more mature business that really needs someone that is more operationally focused might not be a great match. And having someone that is purely operationally focused for a business that's a little earlier in its life cycle, that might not be a great match. So we're really, again, focused on trying to make sure that we've got the right team for the right company at the right time, and that they have a history and an aptitude to execute.
So that's interesting. So you could be excited about a company's financial metrics, but maybe not excited about the management team. And if there's a shakeup or a change in management, like, would that take something off of kind of a no-fly list and put it on a fly list for you?
Yes, absolutely. And it's happened a number of times in the past where we have found a business that we are interested in, but where there is a misalignment of interest with the management team. And then oftentimes that'll be either the wrong CEO in place or the wrong compensation structure. And when we'll see that change, you bring in a new CEO and you change, just as for instance, compensation structure from being focused on hitting revenue or earnings targets, and then being all of a sudden there's a return component, whether it's return on invested capital, return on equity, et cetera. And that will be a catalyst for us to reevaluate, perhaps take a position in that.
Yeah, that's interesting. So you talk about risk management being paramount. How are you quantifying what the downside risk is? Like through kind of fundamental analysis and, obviously looking at management, like how are you identifying and quantifying the risk of the downside? Because it's a lot easier to be optimistic, I think, in finding what the growth opportunity is, but sometimes the other side of the equation is a little bit more difficult. Can you talk about that process a little bit?
Sure, and this really goes back to Jay and I's day at Arthur Andersen, our days at Arthur Andersen in the business valuation group. We look at it in a number of different ways, and it will change somewhat depending on the business that you're looking at. Right. So let's take a software company as a for instance, and those business models have changed somewhat over the last decade. But if you think about a software company, we'll look at the component of recurring revenue of that business and just say, okay, let's say their new product growth goes to effectively zero, and we've got a renewal rate on this recurring revenue. What does that look like if we just sort of liquidate that into the future? Or we've got hundreds of examples that those types of software businesses tend to get bought for somewhere between 3 and 5 times their maintenance revenue, that subscription revenue. So that's an example. We'll look at a bank where we will take their loan book and do a burn down analysis, category by category, right? So we'll look at the mortgage side of the business or the commercial real estate side of the business, and look at historical periods of recession and what values and losses went to during those times of stress. We do LBO analysis. We will do some of the parts analysis. We've literally looked at shipping companies where we said, what is this? What's their fleet worth in the secondary market during times of stress? And what's it worth as scrap steel? So really hitting on these from a number of different angles. And oftentimes, the reality is that, to your point, the upside may look extraordinarily attractive, but from our perspective, the downside is just too great, or we can't quantify it, and therefore we won't invest.
Yeah, it's an extremely interesting process and completely well thought out and designed. I mean, I talked to a lot of ETF managers, and you guys are definitely taking kind of the extra step of really looking into management and looking to see what the downside risks are. I'm curious, when you start to identify, you run your whole process, you find your investment selection. How are you then compiling the portfolio in terms of position sizing? It's not equal weight, is it? Or you're kind of moving chips around and overweighting some things and maybe underweighting some others?
Yeah, you're right. It's not equal weight. And so we use all else equal, that reward to risk ratio that I mentioned. We use that in order to size positions. So very simply, the greater the asymmetry in that upside versus downside, the larger the position size up to a max of 3% purchase. So the way to think about this is that, over time, as a stock goes up and that reward to risk ratio falls, we'll use that to cut back positions. And then we overlay, I said all else equal, but we overlay on top of that. We have a proprietary risk management model that we employ to help guide us in putting those different positions together. And I always say an analyst's job is to paint perfect stroke on a piece of canvas, brush stroke on a piece of canvas. As a portfolio manager, it's our job to step back and make sure that we have a picture that makes sense. And so our risk model is fundamentally driven. We look at all of the revenue and earnings associated with all of our businesses and break those down based on fundamental factors, things like cyclicality, end markets, et cetera. And then we aggregate that data back up such that we have a holistic view of risk. And so it's a combination of overlaying that on top of that reward to risk ratio.
So when does MGMT have I know it's an active ETF, but does it have a set rebalance schedule when you're kind of rerunning screens and reposition sizing, or are you guys doing everything on the fly over there and things could change day to day?
Yeah, there is no set rebalance schedule. The rebalancing occurs purely when we're either buying or selling positions on a position by position basis.
So when you guys are out there talking to RIAs or advisors or institutions and they have kind of a model portfolio framework already existing in the firm, where are you positioning MGMT as a holding to kind of encompass or fit in that overall model portfolio?
Sure. So it's really two things: either as a replacement to passive ETFs. And many of the ETFs out there within that are competitors for us are either thematic or quantitative or just pure passive. And we are very fundamental and think certainly in times like this where there's a lot of economic uncertainty that's where real value comes into play. And the other is just purely in allocations. We've seen over the last 10 years, large cap growth has obviously dramatically outperformed small cap value. And our perspective is that the next 10 years is unlikely to look like the last 10, and that one should have an allocation to small cap value.
Yeah, no, I would agree with that. And having experience in both the SMA world and the ETF world now, can you talk about just how you see the sales process differently for maybe going out and trying to have an advisor utilize your SMA versus, having a publicly traded process or a publicly traded product and getting kind of ETF allocations? Is the sales process the same? Is it different? Can you talk about distribution a little bit?
Sure. It's I would say it's very different. Within the SMA world, particularly on the institutional side that we had historically focused on, that is very consultant driven. So the process is to get approved by the major consultants, the Cowans and Russells and NEPCs of the world, and that's a process in and of itself that can take years in many instances. But once you're approved there, then you're able to get included in searches anytime there's movement. A public plan or corporate plan needs to replace or add a manager. You're able to be included in those searches. That's very different. What we've learned within the ETF space and much more driven by the RIAs, wealth advisors, family offices, etc. It's just much more hand to hand, and there's the process of building your brand and getting your name out there, but also just a huge effort through our partners at SkyPoint that are just calling on advisors every day, just trying to get them up to speed on the story. And I think it requires a lot more content, a lot shorter content. Our letters for the ETF tend to be much shorter, much more often, and it feels like it's much more of a volume game.
Yeah, no, I couldn't agree more. It seems like running an ETF these days, you've got to be front and center almost every day, and getting that brand recognition. But Ragen, I really, really appreciate your time. Very, very interesting product that I think is well thought out. I think deserves a spot in that model portfolio process, as you said, especially with kind of the environment we may be entering in here over the next few years and next decade. But before I let you go, where can people learn more about Ballast? Where can they learn more about the ETF and get all the information on your firm?
Sure. So you can learn more about the ETF at mgmtetf.com, and you can learn more about Ballast at ballastam.com. And we put all of the material that we write and articles on both the firm and the fund are on either of those two websites. So I would encourage you to go there first. Very much appreciate you having us on the call. And I will tell you, I've always told people when they ask me to sum up Ballast in a single sentence, I would tell you that we're the firm that looks both ways when we cross a one-way street.
That's perfect. Well, Ragen, again, thank you so much for your time. I appreciate all the information and hope to have the opportunity to meet you in the future and learn more about you and the firm.
Absolutely. Thank you, Brad.